Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Really excited for today's show. We've got Irwin Borris on the line with us today. So, Irwin, how are you doing today?
No complaints. Had a little snow overnight and first of the season. It's gone now,
Nice.
but nice to have a little change.
Yeah, Four Seasons is nice. I do enjoy Four Seasons. We had our first snowfall. Today's a Friday. I think it was Tuesday. But so far, I haven't had to shovel our walkway or driveway yet. So far, so good. Well, hey, do us a favor. Tell us a little bit about yourself and, where you're from, what you've been doing, and how you got into multifamily.
Sure. My name's Irwin Borris. I run real estate for a family office called Peykar Capital. I've been in real estate 37 years,
Nice.
uh, pretty much all my life. I
Mhm.
started out as a practicing CPA for a firm that had a lot of real estate clients. It's one thing to look at a bunch of numbers, and that's how most of us underwrite. We look at numbers, but when I decided I was tired of the numbers and the boxes, this is before computers, I went
Mhm.
to work for one of our clients who was a very large owner operator of apartments in the New York metro area. It's on the
Mhm.
Forbes list of billionaires, still is. And they taught me the management side of the business, where it actually stuck me in a four-building complex. I had 1,000 units. I had a 20-man union crew. I had to learn, how to deal with federal and state agencies, go to landlord
Yeah.
tenant court and collect rent. And I got a real appreciation for really what goes into those numbers and
Yeah.
what it is to really make a buck as a landlord.
Mhm. Yeah, and that's kind of a trial by fire, jumping in, and you said 1,000 units was your
Yeah, it
first
was a
job.
five. It was a 20 building complex. I was one
Mhm.
of five property managers. We each had four, direct responsibility for four buildings,
Mhm.
and it was really interesting. You hear about the stories about the tenants' complaints, or there was what was that show, Wuthering Heights, where the tenant ripped out the building and ripped it apart on the landlord.
Yeah.
And
Mhm.
yeah, some of that stuff really does happen.
It does, yeah.
So it's not to be taken lightly.
Yeah, I know you're in the New York area. Were these in New York?
Yeah, these were outside of Manhattan, but they're in New York State,
Okay.
rent stabilized buildings. So
Yeah.
I had senior citizens in there. I had some subsidized tenants in there. I had market
Mhm.
rate tenants in there. The buildings still are today basically the United Nations. So you have to deal with a lot of different
Wow.
cultures as
Yeah.
it relates to how you care for your apartments.
Yeah, absolutely, yeah, and that's probably one of the toughest markets to cut your teeth in, so, like I said, trial by fire. Well, so let's talk about how things progress from that. So you started out managing properties, and let's go from there.
Sure. So I managed managing the properties there, and from there, I went to work for another family that was in the real estate business. I went to work as their controller, had an
Yep.
accounting background, CPA, and I had more of an asset management role, just looking at numbers, comparing on how the operations. And
Mhm.
they were also builders, so I got involved with a lot of the lenders.
Mm.
But I still got to see how the operations were, and then I had an appreciation for the numbers, whether I thought they made sense or they didn't make sense. And because I like to work with my hands, I'm very
Mhm.
tactile. I went on
Yeah.
site a lot, and sometimes I had a good suggestion. Sometimes people told me I was crazy, but I was trying to get the wheel to move faster with less
Yeah.
squeaking.
Yeah, yeah, I like that. I like that. One thing, I'm a recovering numbers guy. I have 2 degrees in math. I'm not so great at accounting. I never learned that one, but I tell you what's really been helpful for me is to see numbers in action. It's really easy looking at spreadsheets. You get much better at underwriting after you've been hands-on, after you've seen how things actually work, and I think your projections end up being a lot better at that point. So,
No, I agree with you 100%.
yeah. Well, cool, cool. So, and from there, where do things turn from there?
From there, I was a banker. It was a very interesting transition because I
Mhm.
had no credit training, but I had an
Mhm.
accounting background. So I knew how to read a spreadsheet. I knew how to read financial statements. I actually had to teach people in one of the lending areas how to read a tax return.
Okay.
Which, so it was
Yeah,
kind of
yeah.
funny. But I was the only one because I had been a property manager most recently
Mhm.
and done asset management work. I was the only one that ever touched a brick.
Mhm.
Everybody else in the origination group was a banker, was a finance guy, and it was just
Yeah.
about moving numbers and seeing if they thought the loan to value and the debt service coverage was there.
Mhm.
So
Yeah.
they sort of referred to me as the piranha in the fishbowl. Some of the fish had to swim faster and some of them got eaten. And because I didn't have the same credit training as everybody, I knew when a deal made sense. So they
Yeah.
gave me somebody to help me get the right numbers in the boxes, and we were very successful. We had some great years on
Mhm.
origination, both for
Yeah.
our balance sheet, and we also did a lot of Freddie Mac multifamily at the time. And it really taught me a lot about how bankers look at things, which to this day, I've carried forward with me.
Yeah. That is an interesting way. And that's something when we're doing loans, I always ask lots of questions because getting the idea of how bankers look at things helps me to, be a better operator and I guess get more from the lenders. That's really what I'm interested in. But, what I find, and I think with your story, it's very rare that I get somebody on the banking side that understands exactly what we're doing. So I find myself asking a lot of questions, but also doing a lot of explanations, like, hey, this is what's going to happen. This is how we're going to do it. But it'd be nice if there was more information sharing, between the banking side and the property side. But
No, there really was, and throughout my career,
yeah.
I've either been a lender
Hmm.
or on the ownership side, or what they call the
Yeah.
dark side. So I've worked for I spent 10 years with GMAC Commercial Mortgage, which is
Hmm.
now called Bricadia. It's evolved and
Okay.
changed hands.
Hmm.
And so I learned a lot about structured finance. I got to hear some of the best lies in the world from borrowers and some of the most creative presentations. So you sort of know when something smells at this point in my life, whether it's a seller or
Hmm.
whether it's a broker trying to sell me things. What did Ronald Reagan say? Trust but verify. And that's what you have to do. But it's been a very interesting, ride through all the asset classes.
Hmm.
The multifamily is, you think about it, you need a place to sleep. You can't be virtual. You can't go shopping
Yeah.
online. You can't sleep online. It's unfortunate that the cost of housing for a lot of people has become very serious as people pay a larger percentage of their take home income for it. I don't know what the solution is, but it's a social problem. And
Yeah.
hopefully the government will figure it out someday in a
Yeah.
capitalist regime, of course. Um,
It's yeah, I mean, the answer is simple. It's build more houses, build more apartments. I do a lot of investing in Utah, and I was talking with somebody from the governor's office, on that housing commission the other day. And, it's one of these things where I like how you made that last part in a capitalist manner, but the governor in Utah is trying to incentivize builders to, put up a certain amount of homes in the next year that are, for first time home buyers. And I was scratching my head thinking, how is it going to pencil for the builders if, but anyway, the answer to the question is to build more.
yeah, to build more, but then people that own already, if they're building, your
Yeah.
values go down because there's more supply.
That was my point to that person yesterday. I'm like, honestly, 35,000 new homes scares me because that's going to put a significant, I mean, in New York City, that'd be a drop in the bucket, but in Salt Lake City, that's a lot. But
Yeah, you think about the
yeah.
infrastructure attacks of the school system, the sewer system,
Yeah.
municipal, hospital, fire. It just keeps evolving. And then the town's budget, the municipal budget keeps growing to provide all the services. And then where there's available land to build that's really inexpensive, no one wants to live.
Yeah.
So I don't really have an answer. It's a problem that we'll have for a very long time.
I agree. I agree. If it was a simple problem to solve, it would have been solved already. I think this is probably true nationwide is when you look at builders are willing to build the things that make the most profit. And if they're not building affordable housing, it just means there's no profit there. So, but yeah, I know several municipalities, several states, several, are trying to kind of crack that code. And I sit on two sides of that coin. I've got, adult daughters that can't afford to buy a house. But on the flip side, if they make housing affordable, that's going to bring that's going to affect business. It's going to affect my livelihood. So I don't know. Part of me wants to see them solve it. Part of me doesn't. Yeah.
They can't win.
Yeah. It's conundrum. So, but yeah, it is a problem nationwide. And while the problem exists, investing in multifamily and housing is probably going to be a pretty safe bet, is what I got to say.
I think it's going to be a safe bet, but it also depends on what your investment horizon is.
Mhm.
We stopped investing in multifamily probably 4 years ago. Maybe
Mhm.
people tell me I was too early. But
Mhm.
when the cap rates compressed and there was no spread between your cap rate and your cost of finance, you had
Mhm.
to go in upside down. It wasn't fun. That, and I have a huge database of all the deals that people have sent me or I've looked
Mhm.
at over the last 15 years. It's interesting to see how many times some of these apartment complexes have traded over the last 12 to 15 years.
Yeah.
Many of them had the same business plan. How many
Mhm.
times can you replace a kitchen and a bathroom
Yeah.
and flooring and move the rents $300? It's hard. It's hard to get done in a perfect, ballet manner, like for the trajectory you need to go cash flow positive to generate the IRR.
Yeah.
And then, thankfully we got out of the apartments because in the last 2 years, we all saw what happened to insurance costs,
Mhm.
and payroll
Oh, yeah.
costs and real estate taxes. And I'm like, thank God we've been doing triple net,
Mhm.
multi-tenant industrial. Uh,
Yeah.
but, so thank God for that. But when you think about it, we had a really long run since,
Mhm.
2010 through, 22,
Mhm.
where even the leaky boats came off the bottom of the ocean.
Yeah.
And then when the interest rates started to move and the insurance moved against them, they couldn't bail them out fast enough. And it's
Mhm.
unfortunate that, I know there's a lot of investors out there that have faced capital calls. Some
Yeah.
may have lost their investment. Then again, although because I'm an old guy already, you
Mhm.
look at the faces of some of the syndicators. I think back in 2008 to 2011 or 12, they were probably in
Mhm.
high school or college, so
Yeah.
they hadn't really seen the cycles.
That is true. I think, to one of your points earlier, I've seen this several times. And by the way, this is going to be episode like 508 of this podcast. So I've talked with a lot of syndicators and I get a lot more information, before we hit the record button and after we hit the stop button. But I think with these apartments trading hands with the same business plan. What I've seen happen a lot, especially with the newer syndicators, is they walk in undercapitalized. They start their renovations, they get one third of the renovations done, they hand it to the next syndicator who's like, well, we're just going to finish off. But I mean, that's definitely happened. And I mean, to your point, those were a lot of leaky ships, leaky boats,
There
but
are a
the
lot of
market was
leaky
doing
ships,
so
and
well.
nobody
Yeah.
expected expenses to move. If you look at some of those original projections, expenses moved at 2% a year, and rents moved at 7.
Hmm.
And no,
Every
we
deal
don't need
works
a
like
full
that.
term interest rate cap. We'll take a 2-year interest rate cap.
Oh, yeah, yeah. Every deal works like that. But I was fortunate. I started syndicating in 2019. I already had gray in my beard, though I shaved, I was military, so I shaved every day. Nobody would have known it. But we were fortunate that we had two local credit unions that gave us bridge type products on a fixed rate. And so we
Wow.
had several bridge loans that did the renovations that had the same like 80% LTC that a lot of people were looking for, but at a fixed rate, and we had like a 3.7 was the rate they gave us on 4 properties.
Well, that's
But
what probably saved you is the fixed rate.
yeah, no kidding. Yeah, that's exactly what saved us. And it was a 5-year loan. They gave us a 5-year loan term at 3.7. I'm looking back at, how fortunate I am that we made that discovery. Had we done the same bridge loans that everybody else had, I probably would have had 3 or 4 deals that went south, myself. So, it just, I don't know if it was dumb luck or, just we turned over enough stones to find that lender. But yeah, that's exactly it. It's to your another point you made. You guys pulled out 4 years ago. 4 years ago, I probably would have called you crazy for pulling out. Right now, I'm like, man, that's pretty dang smart. So good for you
Yeah,
guys.
we own one
Mhm.
complex. It's 448 units, and my debt doesn't mature for another 4 years.
Yeah,
And it's in a military location, and I can't raise the rents fast enough. I'm still 98% occupied.
yeah,
So, and we know it was an exchange for us. There are 8 ticks in there, so
okay,
we're prepared to hold it for the long term. We love it, but
yeah,
just because we've always been in the commercial space with
mhm,
industrial and small bay and large warehousing, I'm
mhm,
like, thank God everything is triple net. Thank God. When if it
yeah,
wasn't triple net, it was modified gross where the tenants had pro rata on all the increase in expenses. And and those deals were trading at wider cap rates
mhm,
than the multifamily, so you went in cash flow positive. Uh,
yeah,
the one thing I've learned in the last 5 years is don't count on eating the IRR because it's not going to happen. A lot of investors, especially new investors that went into some of these syndications, were enticed by look
mhm,
at this multiple, look at this
yeah,
IRR. And I know there was some syndicators that had some litigation because when they marketed an 8% preferred return, people thought they were getting 8% a year.
yeah.
That was just a metric for computing the returns. Doesn't mean you're
Mm,
getting anything till they sell.
yeah. Yeah, and that's, interesting you mentioned that one. I mean, it's hard, and I've seen a lot of people that are like chasing returns. When I have an investors that are chasing returns, and what I mean by that is they're looking at my deal and saying, okay, you're saying 17.2, these guys over here are saying 17.5. That's kind of ridiculous, but it does happen. It does happen.
The one thing you
Yeah,
got to tell investors, whatever you're seeing on the paper, I guarantee you that it's not happening.
yeah. I say
Might be
this,
better, but
yeah,
it might not be.
I say this all the time, when I show my numbers, I'm like, the only thing I can guarantee you is every single number on that spreadsheet is wrong, you know? I mean, that's it. These are our best projections, but I guarantee you, I mean, we're taking everything and calculating it down to the nearest penny, but I guarantee you everything on this spreadsheet's going to be wrong. But we're going to try to hit that percent either way. But anyway, that's my math background looking at these forecasts. I know I'm going to be wrong on everything, but
Yeah, we know we're going to be wrong too. We've been pleasantly
so
surprised on most of them.
yeah.
So
But yeah, I mean, what you can't be wrong on is operations. You can't be wrong on operating the property and stuff like that. But so just curious. I mean, you guys have been out of multifamily for a while. What's your you look into your crystal ball? What do you see in multifamily in the next year? And are you guys going to be jumping back into the multifamily space?
we would like to jump back into the multifamily
Mhm.
space.
Okay.
We manage all our commercial stuff ourselves in house. We have 6 million square feet. But the
Okay.
multifamily, I don't want to know about clogged toilets and leaky roofs and domestic violence and
Mhm.
dishwashers that overflow. So we actually use third party for that. But we're starting to see cap rates move out
Mhm.
in some locations. But I'm also wary of the vintage.
Mhm.
In one of my first jobs in banking, the bank was owned by a developer who
Yep.
thought that anything that was stick built was a temporary use for the land. So he's thinking
Okay.
wood frame garden apartments, not wouldn't lend on them because they could fall down. They need a lot of work. You got to worry pests, termites, whatever. And
Mhm.
so when I look at a lot of these deals that are starting to trade, these 60s and 70s vintage. Okay, in some
Mhm.
locations, your house could be 50 years old. We don't think of that, but for an investment, do I want to buy something that's 50 years old?
Mhm.
When was the last time it was rewired, new plumbing, all that stuff, it becomes a big nightmare if it hasn't been done. And most people don't think about it. Well, it's functioning now. So I guess we would look at stuff that's probably, 2000 and newer. But I
Mhm.
also want to be able to, figure out where interest rates are so I can be cash flow positive because I'm not betting on being able to go in with negative cash flow and value add myself a return.
Mhm.
So it might be some time, but we're looking and we're starting to see some distressed opportunities.
Mhm.
But yeah, I got to bring $1.5 million to the table. I got to extend an interest rate cap. And one guy had this value add plan, and I'm like, look, I know that location. You were crazy to even buy that thing.
Mhm.
It's never going to work. One guy's value add plan, it looks like lipstick,
Mhm.
and I haven't seen anything that worked. I know
Yeah.
people are still buying apartments. I think I'd feel better buying an old motel and
Mhm.
converting it to apartments, or an old nursing home and converting it into regular apartments. Something where I have some infrastructure and the bones are probably pretty good.
I mean, you make some good points with the older properties. I started out buying 60s and 70s, and when you talk
Would you
about,
buy one now?
you know what, I don't want to buy something that old now. But pros and cons to it, and you bring up, I think the points that people should be asking, the electrical systems. That's one thing that a lot of those things have clocks on them that kind of tick down. But the other thing is insurance on those properties is a lot higher than they are on newer apartments too. So a lot of your cost of ownership goes up, your maintenance goes up. You've really got to plan for that if you do want to buy the stuff. And I think the first couple of 60s and 70s build properties that we purchased, we didn't anticipate as much on the plumbing. We didn't anticipate as much on everything else. But yeah, I mean, I would say those properties are not for the faint of heart, is all I'll say. So
No, you got to have a strong stomach for that.
lots of issues that pop up, and you've got to be really, really careful when you're doing your due diligence as well. Make sure you got good bones. That's one thing I've learned, by experience. Is we bought a couple properties that were 60s and 70s build that didn't have good bones, and yeah, it makes it a lot harder. Well, cool. So potentially getting in, you say 2000s and newer, and larger apartments now. Well, awesome. So what else are you guys investing in right now? I mean, what else?
We're seeing, because we were big. The parent company uses a lot of warehouse space. We manufacture and import rugs. We're a
Okay.
big user of warehouse space, so we taught ourselves how to build it, both for ourselves and we build for third parties. That's one thing that was always the orphan stepchild of real
Mhm.
estate, which all of a sudden everybody's waking up to and wants to own it.
And now it's the
Uh,
belle of the ball. Yeah, exactly.
yeah, and we've always done well with it. It performed well during COVID.
Mhm.
Everybody paid because no one wanted to be home with their wife and kids in the garage or working out of the basement. And it's
Yeah.
just a question of if you buy what I call a small bay deal that's got 20 units,
Mhm.
they could be anywhere from 1,500 square feet to 5,000 square feet. That's sort of like the multifamily, the industrial world. That's like credit
Mhm.
by design, because credit by diversification, because you have that many tenants. It's
Yeah.
almost like an apartment building.
Mhm.
And either they're modified gross, where the tenant pays pro rata increase of all the operating expenses, or
Mhm.
they're all triple net, where everybody pays
Mhm.
all the expenses. And we've been really lucky at finding those things at 8 and 9 caps. Is one
Mhm.
we're playing with now. It's a 10 cap.
Wow.
And because of where interest rates are, and they've been held, the market's been stagnant, all asset classes. We
Mhm.
even have seen sellers start to provide seller financing, because
Wow.
they've decided that we don't know what's going on. We don't know what's going to happen with the new president, what's going to happen with
Mhm.
inflation, what's going to happen with the deficit, where are rates going. So a lot of guys are saying to me, you know what? We're still making money. It's time to take some money off the table
Mhm.
and put it in my pocket.
Yeah, it makes sense. I mean, I go back and forth on where I want cap rates to go, but if you can buy at a 9 cap,
And finance
that
at a six.
yeah.
So
So that opens up cash flow. I mean, Salt Lake City, we're buying at 5 and a quarter cap, and our interest rates are, we signed at a 5.3. So we got about parity on cap rates versus interest rates, but
yeah, and then once you also factor in the rest of the capital and your capitalization for any value add program,
yeah.
you don't have any cash flow to distribute.
No, we won't for the first year. It's something that you just have to make sure your investors understand. But we're looking at value add deals. I think Salt Lake's a great market to invest in, and I think we are going to have appreciation. But it's a different risk profile. We're not cash flowing year one, and we're putting value in, we're raising rents, and it is a little bit more risky than buying at a 9 cap, and where you have that cash flow. But we'll see. I mean.
No, Salt Lake is a good industrial market as well,
Yeah.
where the cap rates are lower. We've looked at it several times,
Mhm.
and I'd love to find a way to get in there. But it's also a growing market,
It
so
is.
you keep have population growth, so you need more apartments here.
Yeah, I've seen forecasts, 60% more households by 2040, and
Right.
so, and that's the Wasatch Front. And so, there are a lot of dynamics to consider when you're investing in multifamily. And I saw a report that came out of the Salt Lake market last week that said, that the future growth is why people are still buying things, that are upside down on the spread between have upside down spread, negative yields. I read that. I'm like, you know what? That's accurate. That's accurate. We're growing fast. There's supply and demand imbalance, and I think it is a calculated risk. But I'm a one trick pony. I don't. I know how to do multifamily. I don't know how to do the other stuff yet. So
Right.
anyway, well, cool, cool. Well, let's start wrapping up here. A couple questions to finish off, and first one is, what's next for you?
Well, through all the years of looking at industrial and
Mhm.
small bay properties, and as an owner, I got to read a lot of financial statements for tenants.
Mhm.
And we're looking at the aging of the population now, and there's a lot of businesses for sale. And you'd really
Okay.
be amazed at the profit margins of some of these small, third party logistics, these trucking companies, where
Mhm.
it's 25 to 35% net cash flow on
Mm.
an unleveraged basis. And
Wow.
so we're making an offer on our first, delivery service company,
Okay.
because I can buy these things for 800 to $1.5 million. Some
Mhm.
will give me seller financing, and if I can get 25% cash flow, we're fine.
Mhm.
I don't care about the depreciation,
Yeah.
because that's the only thing we know is cash flow.
Yeah.
So we're going to
Awesome.
start looking at that, and as multifamily comes back around, we always look at it, but I think
Mhm.
that's going to be the next avenue. And I have some confidence that that will work, because if you
Mhm.
look at what the private equity shops are doing, where they're rolling up medical and dental practices on a national basis, and
Mhm.
roofing companies on a national basis, and air
Yeah.
conditioning companies, HVAC companies on a national basis. So what's to say I can't do this with trucking and logistics? And I know
Mhm.
guys that own 60 and 70 of these things in certain locations, and they're telling me how they built their empire. And I'm like, you know what? It's cash flow, and that's why they did it.
Yeah, absolutely. I actually saw an investment come across my desk for somebody who's raising for a trucking company, and that was the big thing that I noticed is how much cash flow it was spitting off. So I don't know much about it. So, but anyway, that's if you can get the cash flow, great play there. Next question. What advice would you give to somebody who is just getting into multifamily right now?
I think they got to go in eyes wide open. Question everything. Do your homework. If you're going to try to do it yourself, unless you have expertise
Mhm.
in, repairs and maintenance and plumbing and electrical, then don't do it yourself because you don't know if the contract is telling you the truth or what the building really needs.
Yeah.
And so you might want to partner with somebody else, maybe there's somebody else on a para pursuit or on a co-GP basis, just so you can really learn
Yeah.
and make yourself available to be on site and learn more about the operations of the building.
Mhm.
Maybe you take some, renovation course or plumbing course or electrical courses. All the schools have them at night, just to have some basic understanding of repairs and maintenance. If you're someone that's really handy and Mr. Fix It and does this stuff around the house, you're much better off. But I'd also figure out how much you could afford to lose of your money because early on, there's a better chance that you're going to lose it, until you really learn and get a firm footing.
Mhm.
And if you don't have the money to lose, don't do it. It's
Yeah.
easier to go into a syndication with someone you've thoroughly vetted and get that cash flow than try to do it yourself and lose the money.
Yeah. Yeah. And I mean, if you're going with somebody who's thoroughly vetted, you're going to learn from them as well. So,
Yeah, you got to learn from them, but learn to ask a lot of questions and,
mhm.
ask to go on site tours and ask to walk the property with the property manager, although they might think you're crazy. But, you maybe you go shop the property
Mhm.
and ask the questions like, this looks like an old building. What can I expect as a tenant? What's going to break?
Yeah.
You know, pretend you don't know and pretend you're not an investor and see if you
Yeah.
can get some information on some of these buildings. Just, pretending to rent them.
Yeah. I think the best information and being on the property really, really helps. I drove by a property that we own on Saturday afternoon. It was right as the sun was going down. And our maintenance guy happened to be on the property, and just walking around with him for 2 hours. I didn't intend to walk around with him for 2 hours, but we did. But man, I learned more about that property from the maintenance guy than anything else. But yeah, I agree. Get out, get on the properties, get with the property manager. I ask my contractors a lot of questions too. They probably don't like to see my calls very much because it's a 20 question call, but not really. But anyway, all right, last question, and we'll wrap this up. How can listeners learn more about you?
Sure. I am easily searchable on Google. If you put Irwin Borris into the search
Mhm.
bar, you'll find me. I'm on LinkedIn, Facebook, Instagram. You can email me at irwin.boris@paycarcapital.com. You'll find it. I'm there. I speak at a lot of conferences. And so, I'm not there to really tell anybody what to do, but I'm there more to really see what I might be missing. Never assume you know it all. Always be open minded because there is always something to learn, no matter what age you are or how accomplished you are. So
Yeah.
just be
Abs-
careful.
Awesome. Thanks a lot. Appreciate your time today, Erwin. And I think we had a pretty good little show here.
No, I appreciate your time today. Thank you so much.